Behind every single loan, every single investment, there's a calculated risk. For banks, managing that risk isn't just about their own profits. It's about protecting the health of the entire economy. So today, we're going to break down the really important framework the Reserve Bank of India has built to make sure that happens. So let's start with a big question. If you had to pinpoint the one single risk, the one thing that could truly bring down any bank, what would it be? Well, the answer gets to the very core of what banking is all about. And here it is: credit risk. It sounds technical, but it's actually pretty simple. It's the risk that a borrower just won't pay you back. Now, if that happens on a huge scale, it can set off a chain reaction across the whole financial system. So managing this isn't just a good idea, it's absolutely essential for stability. And that is exactly where the Reserve Bank of India steps in. As the country's central bank and top regulator, it's the RBI's job to set the rules of the game. They've created this comprehensive framework that all banks and even non-banking financial companies, NBFCs, have to follow to keep credit risk in check. So where does a framework like this even begin? Well, it starts right at the very top, with governance. This is seen as the first and honestly the most important line of defense, because at the end of the day, responsible lending starts with leadership. And the RBI is crystal clear about this. They mandate that accountability for credit risk doesn't start with some junior loan officer or in a back office department. Nope. It begins and ends in the boardroom. The ultimate responsibility sits with the highest authority in the entire organization. And you can see how this flows from the top down. First, you've got the board of directors. They set what's called the risk appetite, basically deciding how much risk the company is willing to take on. Then that same board has to approve all the critical credit policies, the rulebook essentially. And finally, it's up to senior management to take those policies and put them into practice every single day. Okay, so that brings us from the who, which is the leadership, to the what, the policies themselves. If governance points the ship in the right direction, these policies are the detailed map, the official rulebook that guides every single lending decision. And let me be clear, this is not optional. The RBI's own language is really direct. This quote says, "An NBFC shall put these policies in place." In regulatory speak, shall means you must. It's a command, not a suggestion. And they have to be board approved, which gives them serious weight. So what goes into these policies? Well, the RBI outlines some core principles. First, any credit appraisal has to be independent and objective. You can't just take the borrower's word for it or rely on a report they paid for. You also have to dig into where the owner's investment, their equity, is coming from to make sure it isn't just another loan dressed up to look like capital. And crucially, lenders have to make sure the money is actually used for what it was borrowed for. Now, principles are great in theory, but what about in a really tricky, real-world situation? Let's zoom in on one of the highest risk areas, conflicts of interest, specifically something we call insider lending. Here's the classic problem, right? A director on the board could be tempted to push through a shaky loan for their own company, or maybe for a business run by a relative. So the RBI solution is to build very specific, very strict controls, processes designed to drag these situations into the sunlight and make sure they're handled properly. The framework often uses very specific numbers to trigger these special controls. And when it comes to insider lending, there's one number that really matters: 5 crores. So here's why that number is so important. Any loan of 5 crore rupees or more that goes to a director, their family, or a firm they're connected to, well, it can't just be approved by some manager. It absolutely must go before the entire board of directors for a full review. That's a huge check and balance right there. And the process doesn't even stop there. The director who has the conflict of interest is required to formally declare it to everyone on the board. But here's the most important part. They are strictly forbidden from voting on it. They have to step aside, making sure the final decision is made only by impartial members. All right, so far we've mostly looked at risk inside one institution. But risk is connected, right? It doesn't stay in one place. So the RBI's framework also zooms out to look at the entire financial system and how to create transparency across the board. And this brings up a huge question. A borrower might look like a great risk to your bank, but what if they have massive hidden loans with 10 other lenders? How can any single bank see the total picture of that borrower's debt? The answer is a pretty brilliant tool called the Legal Entity Identifier, or LEI. The best way to think of it is like a corporate passport. It's one unique 20-digit global code that identifies a specific company in any financial transaction anywhere. No more confusion, no more hiding behind different names. And hey, would you look at that number again? 5 crores. The RBI mandates that any company that borrows 5 crores or more in total, that's across all banks and NBFCs combined, is required to get an LEI code. This one rule is what connects all the dots across the whole system.
And the impact of this is massive. First, it makes all the financial data way more accurate. It helps regulators spot system-wide risks before they blow up. And for lenders, it means no more nasty surprises about a borrower's hidden debts. Plus, this rule has real teeth. If you're a borrower who needs an LEI and you don't have one, you're cut off. No new loans, no renewals.
So let's pull all these threads together. What we've been looking at isn't just a random collection of rules. It's a fully integrated, multi-layered defense system, and it's all designed to strike that delicate balance between letting the economy grow and keeping it stable.
This table really sums it up perfectly. You've got 4 layers. Governance is at the top, setting the strategy. Then you have policy, which is the rule book guiding the decisions. Then you have specific controls, like those insider lending rules, to stop abuse. And finally, you have system-wide oversight, using tools like the LEI to create transparency for everyone. See how each layer supports the others? It's a really smart design. And if you're still wondering why this matters so much, this quote from the RBI itself just nails it. When credit risk isn't managed well, the damage doesn't stay contained. It bleeds out and creates problems in all sorts of other areas. Getting this one thing right is absolutely fundamental.
So I'll leave you with this one final thought. This entire framework is a massive balancing act. Let's be honest, risk is what fuels growth. No one builds a factory without taking out a loan. So the ultimate challenge for both the regulators and the banks is to make sure these vital rules protect the system without accidentally choking off the very risk-taking our economy needs to thrive.